Market breadth has been absolutely terrible this year. A very few stocks have been rising spectacularly, whereas the rest of the market is pretty much languishing. Now, this has become a very big topic of conversations in markets this year, but I'm going to approach this from a different perspective than you've probably heard from anywhere else. Instead of just approaching this from a purely technical analysis perspective, I'm going to provide you with a fundamental economic interpretation of what has been going on in terms of market breadth. There are dozens of statistics that are being widely discussed in the market right now regarding how bad breadth is. Now, I'm not going to go into a whole lot of those statistics, particularly the most sophisticated ones, but I am going to mention just a few interesting facts. First of all, the S&P 500 index, which is a market capitalization weighted index, is up about 15%. But the equal weighted S&P 500 index is only up about 5%. The median stock in the S&P 500 is only up 3.77%. And every single stock in the bottom 40% of the S&P 500 is actually down for the year. The Dow Jones Industrial Average is only up by about 4%, and the Russell 2000 Small Cap Index is up 0% so far this year. Now, here's another little interesting statistic, which is that the average stock in the S&P 500 this year has corrected by 15%. However, the overall index, which is market capitalization weighted and is very influenced by the top stocks, its maximum drawdown this year has only been 5%. And in fact, we're actually going through a period right now, which is one of the longest periods in history where the market hasn't even had a 2% correction. Now, the average stock in the NASDAQ, interestingly, is down 38%. And the average stock in the Russell 2000 is actually down 29%. So there's a huge divergence between what's going on with the hottest stocks in the S&P 500 and what's going on with the rest of the market. Now, when analyzing the broad market, technical analysts consider breadth statistics to be some of the most important indicators of market health. For example, a trend line in the market is only considered to be truly reliable when it's accompanied by strong breadth. Perhaps most importantly, when the market makes new highs on really poor breadth, it's considered to be a warning signal. It's not a definitive signal that the market is about to reverse to the downside. But when this is followed by important price signals, such as a breakdown below an important support level, this can trigger an overall sell signal on the part of technical analysts. Now, as those of you who follow me know, one of the things I stress is that technical signals oftentimes have fundamental interpretations. And when certain fundamental conditions are in place, it can really help to confirm a technical signal. Now, this is certainly true of breadth. Poor breadth, where just a few stocks, hot stocks, are increasing in price at a very fast rate, whereas other stocks are doing poorly, can be a price signal that's reflective of something that's going on in the real economy. In particular, what it can mean is that there's a lot of capital flowing towards some sectors of the economy, and there's not enough capital flowing to other sectors of the economy. So this can cause misallocations, or what's called malinvestment of capital. And these sorts of misallocations of capital and malinvestment can create distortions in the economy, which later need to be corrected. And it's precisely the correction of those distortions that can lead to recessions. Historically speaking, long periods of time in which there have been significant amounts of misallocation of capital and malinvestment have often been associated with large stock market bubbles in narrow sectors of the stock market. This is not too surprising, because if large amounts of capital are flowing in to certain parts of the real economy, you would expect that to also be reflected in prices. In fact, you would expect it to be anticipated in the price action. And that's exactly what we actually see when we study the stock market. Now, the consequences of these misallocations in the real economy is that too many resources are allocated to a certain part of the economy. Too much labor resources are allocated to a certain part of the economy. Too much physical capital is invested in a certain part of the economy. Ultimately, those resources aren't being utilized profitably. And when there's eventually a bust in that particular sector because profitability isn't high enough to cover the cost of capital, then those misallocated resources sort of crash. There's a lot of unemployment that gets generated in those sectors of the economy. There's a lot of bankruptcies and business failures in those segments of the economy. So there's a shock in this sector of the economy that creates sort of a snowball effect that starts hitting the rest of the economy, and that's how you get a recession going. Now, the stock market can be a leading indicator in the economy. It can also help give you signals about what's going on in the real economy. And so here, what we can see is that in a situation when there's poor breadth, you have the majority of the markets that's languishing, sort of signaling that not enough resources are probably being devoted to certain segments of the economy. And then you have another really hot sector that's receiving too many resources. Here, poor breadth is signaling malinvestment. It's signaling misallocation of resources, and it's signaling a setup in the real economy where there's going to have to be a correction of these misallocations. And that process of correction of the misallocation is the bust after the boom that triggers a recessionary spiral. This pattern that you see in the real economy usually has an analogy in terms of the price action in the market, where the hottest sectors of the market, when they finally crack and they break through important supports, the breakdown can often be very, very sudden. And this breakdown of support in the previously leading sectors of the stock market, the hot sectors of the market, can be a signal of the end of the bull market. And a signal of an end of a bull market from a technical perspective can often be a leading economic indicator of the end of a business cycle expansion and the beginning of a recession. Now, I want to dig a little more deeply into these parallels between the type of price action that we see in the stock market and things that are going on in the real economy. Now, one of the things that we observe historically is that episodes of serious misallocation of resources and capital are generally associated with periods of high inflation. Now, when you have high inflation in the economy, inflation is just an average of prices, but not all prices are actually rising at the same price. Usually when you have inflation, what you actually have is a few sectors of the economy, prices are rising extremely fast, where the other prices in the rest of the economy are rising, but they're not rising nearly as fast. And so that's creating price distortions in the economy that are causing certain sectors, for example, to become more profitable, which is leading capital to go chase the profits in those sectors where prices have inflated. Now, that overall process of, let's say, average inflation in the general economy is actually being paralleled by what's happening in the stock market. Because as you recall, when we have poor breadth in a bull market, what we have is a bull market that's making new highs. The stock market averages are actually increasing, but the majority of stocks in the market actually are increasing at a pretty modest rate. Some of them are actually falling. But the increase in the overall stock market indexes is being led by just a very, very few sectors. Here again, you see a very interesting parallel between what's going on in the real economy and what's going on in the stock market. I just mentioned inflation, so let's talk about that a little bit. Inflation in the real economy is often accompanied by inflation in the stock market. Both the stock market and prices in the overall economy are inflating. Now, in both cases, this inflation is often caused by overly easy, overly stimulative monetary and fiscal policies by the central bank and by the Treasury. And something you need to be aware of is that we've just lived through one of the most stimulative periods of monetary and fiscal policy in the entire history of the United States. And what's really extraordinary is that all of this has happened during peacetime, and it's also happened at a time when the economy's been expanding. When the economy's expanding, you don't need so much monetary or fiscal stimulus. But when you get that much monetary and fiscal stimulus, it'll tend to cause inflation in the real economy and inflation in the stock market. Inflation in the real economy is associated with big price distortions in the real economy, where certain prices are rising a lot faster than other types of prices. And in terms of the stock market, the inflation of the stock market under these sort of conditions is usually also associated with bad breath, where you have the prices of certain sectors in the market rising extremely fast and other sectors of the stock market languishing. Now, I want to get even a little more deep into the fundamental analysis. As many of you know, Friedrich Hayek won the Nobel Prize in Economics in 1974, based in part on the work that he did on business cycles in the 1930s. Now, in his work on business cycles, the main insight that Hayek brought to bear was the role of relative price distortions. Now, I want to focus on that because I think that we're actually going through a period of time that could potentially present some similarities with some of the situations that Hayek was studying back in the 1930s when he looked back historically at business cycle or trade cycle fluctuations that happened before that time. There's a particular pattern that Hayek theorized about, which is that when the central bank produces too much monetary stimulus, and this causes monetary inflation, we're not talking about consumer price inflation here, we're talking about inflation of the money supply, then this actually creates relative price distortions in the economy. But he was focused on a very particular type of price distortion. He theorized that overly easy monetary policies would cause excessive credit creation, and that most of this credit creation would tend to flow initially towards the capital goods sector of the economy. And this would in turn cause inflation in the capital goods sector of the economy. In other words, it would cause the prices of capital goods to rise. Now, this boom in the capital goods sector of the economy would cause too much labor to be allocated to the capital goods sector of the economy. It would cause too much capital to be allocated to that sector of the economy. The next step in the process would be that the boom in the capital goods sector of the economy, in other words, the capitalists and the workers that were getting paid high wages there, would create a boom in consumption. But since not enough capital had actually been allocated towards the producers of consumer goods, then there wasn't enough supply to meet the demand, and this actually created inflation in consumer goods. This would in turn cause a tightening of monetary policy. Now, eventually, there would be a bust because there wasn't enough consumption to meet overproduction of the capital goods. In other words, there was the returns on investment on all the capital goods production was below the cost of capital. And the rise in interest rates that I just described would make the situation even worse for capital goods producers because it would be harder to finance the purchase of capital goods. And so that would eventually cause this correction where unemployment would be created in the capital goods segment of the economy. Businesses would go bust where too much capital was invested. And this would in turn cause a slump in consumption. And the slump in consumption would then, of course, hit the consumer goods segment of the economy. And this would create a downward recessionary spiral. Now, over the years, there's been a tremendous amount of debate about Hayek's theory of the business cycle. Some of this debate has been purely theoretical, and some of the debate has been about the extent to which actual business cycles subsequently matched up to Hayek's theories. Now, there's a lot of debate on that, and I'm not going to get into this now. But I would actually like us to just examine right now in the current situation we're in, because Hayek would be the first to say he wouldn't expect that every single business cycle was going to be like every other. He was talking about a general tendency that might tend to occur, particularly in an inflationary environment and in the type of business cycle that would be particularly impacted by extremely easy monetary policies. In the particular business cycle that we're in right now, we clearly went through a long period of time where we had very, very easy monetary policies. So it might be worthwhile to examine if the type of situation that we're in right now is the type of situation that Hayek described. What do we actually see in the U.S. economy, in the U.S. stock market right now? What are the hot sectors? What are the sectors where all the money is flowing to? Well, very interestingly, it happens to be in capital goods sectors. There's a huge boom in the construction of factories that produce semiconductors. There's a huge boom in the construction of facilities for data centers. There's been a huge boom in the infrastructure to build out alternative energy. Much of that has been actually stimulated by the Biden plan to subsidize construction in that particular segment of the economy. The boom in these sectors in the private real economy is exactly parallel to the boom that we see in the stock market. It's precisely been in the producers of these capital goods, such as Amazon with its data centers, NVIDIA with its production of semiconductors, Microsoft with all of its infrastructure that's oriented towards AI. Google's biggest growing business is also cloud computing, data center, AI infrastructure. All of these things are part of a capital goods boom. This reflects the boom that we see in the stock market concentrated in these capital goods sectors. Another big boom that we're seeing right now is precisely in the construction sector, but in the construction center devoted to building out the alternative energy infrastructure that's being subsidized by the Biden administration. Now, this boom in the capital goods sector of the economy hasn't been paralleled by the same type of investment into consumer goods. Now, one of the areas where we can clearly see this is in the housing sector. The housing sector is, in a way, the most important consumer segment of the economy. There just hasn't been enough building of housing. And so this boom that we see, that increased income, particularly at the upper end of the income distribution, has caused housing prices to increase tremendously, particularly at the upper and upper middle end of the income distribution. Now, this boom in certain capital goods sectors has also stimulated luxury consumption by those that have benefited from that boom. So for a great period of time during this expansion, luxury goods just inflated like crazy, whether you're talking about women's purses or clothing and cars, etc. There was a lot of inflation. Another area where there's been a lot of inflation recently has been in the services sector. And that makes sense because you've had a tremendous surge in demand for services, and especially certain types of services. But it's actually very difficult to make investments in the services industry that will actually increase productivity very quickly. So we've had a surge in consumption of services, but not enough investment in services, and in particular, not enough investment that would actually create an increase in productivity that would enable the supply of services to keep up with the demand. So overall, I think you can see where I'm going with this. There's some very interesting parallels between the patterns that we're seeing right now in our economy today and some of the patterns that Hayek was describing as being typical of a situation where you had a huge monetary inflation. Let's review briefly. We've had an investment boom in capital goods. We've had inflation in the capital goods sector. We've had stimulation of consumer demand as a result of the boom in the capital goods sector. We've had consumer price inflation also stimulated as a result of this boom of demand. We've had an increase in interest rates as a response to increased inflation. I would say that we're well past the halfway point in this pattern that Hayek described. Now, the question is, will the rest of the pattern actually be completed roughly in the manner in which he described? So now what we have to see if we've actually reached the point yet in the cycle where there has been enough overinvestment, enough malinvestment in the capital goods sector of the economy. Let's review some areas where we might actually see potentially some malinvestment that could lead to adjustment. For example, there's been an enormous boom in investment in the whole infrastructure that supports the cryptocurrency economy, the Bitcoin economy. There's a whole expectation that this infrastructure is going to be massively used by consumers that are going to be not only trading Bitcoin, but using it for transactions and so forth. And everybody that's built out this infrastructure is expecting to be able to make a profit from it. But it's possible that all the building out of this infrastructure isn't going to end up being profitable, possibly because there's so much competition amongst these people that are building the infrastructure that fees are going to be too low and they can't make money from it. It could also be that consumers and businesses aren't going to adapt Bitcoin or cryptocurrency as much as expected. If these things happen, we could actually see a lot of business failure occur in that particular sector of the economy. We could start seeing a lot of unemployment. It's people get let go because there was just overemployment in that sector. Now, let's look at another example where we could have potentially had some overinvestment. That is in the alternative energy sector of the economy. There was such enthusiasm to just race to build alternative energy sources, whether it be solar, wind, etc. It's not clear that the huge build out in those facilities is going to be met by other infrastructure that has to be built to complement it. Because if you overbuild solar, which is an intermittent source of energy, you could actually get the overproduction of solar energy during the day, and it can overload the old infrastructure that just wasn't built to be able to handle that. So we might be in a situation where there may have been overproduction of solar and wind facilities, and those producers can get into trouble because since they're overproducing, that means that the price of the energy that they're producing is going to be extremely low. They probably won't be able to turn a profit as their business plans had forecast. And that could actually cause business failures. It could cause layoffs. Now, I'm a big believer in AI, but it's very possible that we may have had a significant amount of malinvestment and overinvestment in certain areas of this build out of the AI revolution. There's been a massive boom of investment in certain areas of AI, but there's other areas that are clearly lagging behind. For example, there's simply not enough copper production in the world that will support the rapid build out of the AI infrastructure. Another key bottleneck is that there's simply not enough production of electricity, of electric energy to enable the rapid build out of this AI infrastructure. So there is very much the possibility that some of this investment may have gotten out ahead of itself, and we might start seeing layoffs. We might even start seeing business failures as a result of these malinvestments. And it doesn't mean that AI doesn't have a future. Of course it does, but it just could mean that some of these investments have been mistimed. And the mistiming of these investments can lead to unemployment, can lead to business failures. And this in turn could kick off a process that could potentially create a recessionary spiral. We're just going to have to see if there's going to be enough malinvestments, enough misallocations of capital and labor resources that could actually create a big problem in our economy. One of the things that we've learned since Hayek's time is that rarely do you actually get a recession from purely endogenous causes. Endogenous causes create these imbalances, but usually in order for the correction of those imbalances to start, it needs to be triggered by an exogenous shock. And in most recessions that have happened since World War II, that exogenous shock has been an oil price shock. And oil price shocks is something that I've discussed in some of my other videos, so I'm not going to discuss it here. But it's important to understand that usually a recession won't actually get triggered until you get an exogenous shock, like an oil price shock, that will trigger the correction of imbalances where they've built up. So let's get back for a moment to this issue of the stock market and relative pricing. One of the things that you often see at the start of a recession is that we see a relative outperformance of oil stocks relative to other stocks, and especially the hot sector that is kind of crashing. That's one of the first things that we should look at as a potential signal in this cycle. If we start to see the stocks of oil producers rising, of oil service stocks rising, and at the same time, we start seeing serious corrections in stocks like Nvidia or Microsoft, that could be a very interesting signal that we've reached the end of this particular market cycle in terms of the bull market, which would in turn potentially signal that we may have reached the end of the business cycle. Another signal that we should be looking for in the stock market is declines in the financial sector, in banks in particular, and also in consumer cyclicals. These would be signals that the economy is starting to really weaken. So let's conclude this video about the fundamental economic interpretation of breadth. Now, it's important to understand that these two things have to work together. If you have problem in breadth, but they're not accompanied by these economic signals that give meaning to the bad breadth performance in the stock market, then that bad breadth performance probably isn't going to mean all that much, or potentially won't mean much. It's really when you get really bad breadth in the stock market, and it's actually accompanied by an economic reality, that I think that the breadth signal is going to be providing or potentially providing a really interesting signal. So I think in this case, there does seem to be very much the potential that some of these breadth signals that we're getting in the stock market could actually reflect fundamental problems in the economy. And we're going to need to monitor those very closely. And remember, what we're looking for are signs of imbalances. And what are some of the signs that we're going to find if we're going to find imbalances? Where we're going to start seeing, for example, some layoffs in some of these very hot sectors. We're going to start seeing some business failures in some of these very hot sectors. These are the sorts of things that we would expect to see at the end of a cycle where we've had a lot of malinvestment. But before we see evidence of the turn of the cycle in the real economy, we're probably going to be seeing evidence of some sort of turn in prices first. Prices generally will lead the economic phenomena. So let's look closely at relative prices in the stock market to give us a leading signal of what might be going on in the economy. Thanks for watching. If you enjoy this type of analysis that integrates fundamental analysis and technical analysis, then you're going to really like to be a subscriber to my channel, because that is one of the main things that characterizes the research that we do in our firm. So be sure to subscribe to our channel, and please leave questions and comments and feedback in the comment section, because I really like to have a discussion with members of our community. So thank you very much, and we'll see you next time.